Hi, good afternoon, ladies and gentlemen. My name is Amay Bodke from Marcom team of India Ratings and Research. I welcome you all to the webinar on Financial Year 24 Mid-Year Macroeconomy Outlook. Kindly note, all participants' line will be in listen-only mode. However, you can type in your queries in the Q&A section. I am delighted to welcome our panelist for today's discussion, Mr. Indranil Sen Gupta. He is Head of Research at CLSA. Dr. Sunil Kumar Sinha, Principal Economist and Senior Director, Public Finance, India Ratings and Research. We have today's presenter, Paras Jasrai, Senior Analyst, Public Finance, India Ratings and Research. I also warmly welcome moderator for the session, Dr. Pan. He is a Chief Economist and Senior Director at Public Finance, India Ratings and Research. I request Dr. Pan to set the context and take the discussion forward. What do you?
Thanks, Samaya, and a warm welcome to all participants and our external panelists, Indranil, whom I will introduce later on. What we are looking at the situation right now, like economy is growing, but the major concern is whether that growth is sustainable. Still, we see the first quarter growth higher at 7.8%. Inflation also in second quarter is expected to average somewhere around 6.5 or 6.7%. Going forward in rest of the fiscal, on quarterly basis, it is expected that the growth will trend downward. However, with WPI now inching towards stable zone, so from deflation, it is now expected to move to inflationary zone in the second half. So how the nominal GDP will look like, because we are so much fixated or we celebrate a lot about real GDP growth, but ultimately in the economy when it counts is how the inflation is behaving, because what you see is your taxes are collected on the nominal GDP. So how the nominal GDP will look like, whether we will be able to achieve what the target set by the government or assumed by the government while presentation of their union budget. And the same number in a way is one of the input for state governments when they go for or they assume their growth trajectory of those state economies. So generally we are focused more about what is happening at the central government level, but what is happening at the state government level is also very important. But right now we are talking about the macroeconomy as a whole. We'll have some other webinar where we'll be talking about how the state fiscal performance are. We had done one earlier. After the 6 monthly number for the major states are available, we'll be doing that also. So without much delay, I'll invite Paras. So the program is that Paras will make a presentation of around 20 minutes. Post that, external panelists will have its own initial remark for 5 to 10 minutes. And after that, we'll go for a panel discussion with Sunil and Indranil, followed by Q&A by the participants. And as a timekeeper and as a moderator, it is my duty to moderate time also. So Paras, of your 20 minutes allocated, please be precise, and I will interrupt you when you will take 18 minutes of your time quota so that you can wind it up in next 2 minutes. So over to you, Paras.
Sure, sir. Sure. Thank you. I will share my PowerPoint slide. 1 second. Is the screen visible?
Yeah, we can see it.
Yeah. So good evening, everyone. As Dr. Pant has said the context, so in the past few years, ever since the pandemic has begun, like the world economy has been facing quite a few frequent shocks, unlike the previous years. And Indian economy has been withstanding these frequent shocks fairly well. And in FY23, there was the world economy was facing the ramifications of the Russia-Ukraine war, and the fact that there was the global monetary tightening, which was in a synchronous direction. And but despite all of that pressures, Indian economy witnessed a a good growth of about 7.2% in FY23, and emerged as a shining spot across the world's biggest economies. So, but as we are right now halfway mark in the fiscal year 24, so how does the overall economic recovery has panned out, and are there any constraints to the economic recovery that we have witnessed? Is what I am going to focus on in these 20 minutes. Yeah. So if you look at the major demand side drivers, then private final consumption expenditure is the largest demand side driver for the Indian economy, having a share of about 60% and followed by the investment demand, the government final consumption, and net exports. Net exports essentially is not a addition to the Indian economy. Reason being that India is has larger imports than exports, and that's why the share is negative. If you look at the various the numbers how they have panned out in so far, then the private final consumption expenditure growth was around 4.5% during this post-pandemic period of FY21 to FY23, and that was very low if you compare with the previous year periods, clearly showing that there was a fair bit of impact of the pandemic as well. And same if you look at the investment demand, then investment demand was fairly good at about 6.2% during the similar period, which was comparable to the pre-pandemic period. But the essential thing to note is that that came on a very vague base of FY20. Same if you look at the government final consumption expenditure growth as well, there also the growth was broadly similar to the pre-pandemic average, and the period of FY20 and FY21 to 23. But net exports, they were fairly like down and out in FY21 to 23, reason being because of a high imports growth. So if you look at the overall consumption demand, how has that panned out, then clearly there is a divergence in the sense that there's a K-shaped recovery where the upper income households are doing much better than what the recovery has been for the lower income households. And a key factor for that has been the way how the real wage growth has panned out. And that if you see, that has broadly for the haves, the growth has been, the real wage growth has been good. But if you look at the growth of the real wages for the have nots, then that has like been a down and out and has only begun to be positive in the past couple of quarters. And a reflection of that is also visible in these how the automobile volumes have panned out, or whether it's the passenger traffic or the housing demand as well. So clearly there's a K-shaped recovery that we are witnessing in the consumption demand. And that if you look at the overall wage growth from the national accounts as well, then we have seen that the wage growth goes hand in hand with the way how the consumption demand pans out. And that's why a critical thing for sustainable growth in consumption demand is a pickup in the wage growth, real wage growth. And there, if one looks, see that what our calculations suggest that 1% growth in the real wages leads to about a 1.12% growth in the consumption demand, and therefore 64 basis point support to the overall GDP growth. So a pickup in the wage growth is important. But if you look at whether this consumption demand is sustainable or not, that is the critical question that we need to ask right now. And there, if you see on the left-hand side chart that the overall savings rate of the households has been like going down ever since like FY12, and broadly has been stagnant since then. And so broadly that indicates that households are like financing their overall consumption by dipping into their savings. And at the same time, what we see is that their leverage has also gone up, where if you see the personal loan to GDP ratio, that has like been going up and up over the years. And even in FY23, it was about 15%. So households are like financing their, in the recent time, their overall consumption growth, consumption pattern by higher leverage, and that is not sustainable if we want a good growth of about 7+ % overall for the rest of the years. And if you look at the overall savings rate as well, that also has been like broadly stagnant since FY12. And the reason why that is important is that a higher amount of savings rate funds your basically your how the overall investment demand pans out. And there we see that the broadly during the FY21 to FY23 period, as I showed earlier as well, the investment demand has grown about 6.2% and on an average, and that has been broadly led by the government capex in since this period FY21. As you can see that both the states and the union have chipped in terms of like providing further support to the economy in terms of the green capex side. But if you look at the overall structure of the investment demand, then that is not enough. If you see that households lead the investment demand pack in terms of growing overall higher investment, and followed by the private sectors, corporations, and these need to take a leading pack in if we want to have a 7% plus growth for the post FY24 period. And there, if you see within the union government capex, the structure has been such that in the past couple of years, the overall focus has been infrastructure, as there has been a higher share of roads and railways in the union government's push. And but one thing we need to look at very specifically is that overall the union government capex can't grow year after year like this, because right now it has come at the cost of higher fiscal deficit as well. And as we know that the union government has to like focus also on the fiscal consolidation path, and that basically means that they have to like the target is to go down below of around 4.5% by FY26. So clearly the private sector has to like take the lead in terms of the capex growth. And there we are seeing that if you see the green shoots are visible in the overall, if you see the capacity utilization or the way the industrial and entrepreneurs memorandum has played out. And even in the that if you see that the business expectation index goes quite hand in hand with the way your industrial entrepreneurs memorandum goes on. So that basically is the investment intentions of the corporate sector, or basically the industrial units, and there that has like gone up quite high. And even in the implementation rate within that memorandum has also been high in the past few years. So green shoots are visible. And if you look at the financing part of that also, then the private sector, the overall project finance also in FY23 had been about 3.5 trillion, which was quite double of the previous year, financed by banks or the external commercial borrowing and equity issues as well. And the sectors broadly were similar as like power and road and bridges and metals. And there were also like the same states and UP, Gujarat were the ones which witnessed a higher project sanctioned by the banks. And what also another positive factor for the corporates has been is that their balance sheets are much more cleaner now, as their leverage has gone down over the years, where what it used to be quite high previously. And we are also seeing that though green shoots are visible overall, but there are some sectors which are essentially also like seeing traction in terms of higher capex, whether it's the cement sector or the telecoms, the renewable capacity addition that also been witnessed, and the health sector also has witnessed a higher bit of capex. So there are some sectors in which it has already started, but there are pressures on the exports front for the overall industrial sector. And there, if you see that while the growth had been quite good for the overall exports during this post-pandemic period, but in FY24 we see it going down to about 3%, broadly due to the fact that there is a slowdown, global economic slowdown, as reflected in the fact that the import demand of North America or the European regions, which are the key export destinations for us, it is broadly to be stagnant in 2023. And if you look at the even recent trend, then broadly the trade deficit is also like widening due to sequential pickup in the overall imports. But services exports have surplus has been quite good and resilient, as is reflected in the chart. There are like some sectors which are going to face headwinds, and some of them are like auto and pharma out of them. Then, as I mentioned, the global economic slowdown is definitely there, as reflected in the global GDP growth that is about 3% during 2023 and even in 2024. So the global growth is expected to remain muted, and you look at the inflation as well, that is like has moderated because of the monetary tightening, and also the commodity prices had moderated, but there's a pressure in the there's a spike in the overall crude oil prices as well. So that basically means that the headwinds are unlikely to ease anytime soon as we are heading. So if you see from the supply side of things, then agricultural sector has been quite resilient, as it's broadly has not been affected by the pandemic. But industrial sector, if you see, that has been like picked up quite handsomely in FY 20 post FY 21, and that is expected to continue even in FY 24. For the service sector, though the recovery was good, but it was not up to the mark as what it used to be, the growth, overall growth, and that is expected to pick up and continue and sustain in even in FY 24 as well. Going deeper into the how the agricultural sector growth is expected for from our side, the monsoon, as you all know, that southwest monsoon was broadly below normal, and but despite that, and that was mainly due to the El Nino impact. But despite that, the overall sowing progressed well, as there was a marginal pickup in the overall sowing, about 0.2%, led by rice. But a concern is the fact that the water reservoir levels are low at the All India level, which is even lower than the 2017 levels. And there's a wide spatial variation as well. So that we think that there is a concern for the rabi production as well. On the industrial sector, as I mentioned earlier, the growth has been modest, led by the infrastructure space, and that also further has got support from the way that the government capex has played out. As you can see, that the capital goods and the infrastructure construction goods have witnessed good growth. But the overall industrial growth is also not quite broad-based so far, because of the fact that the consumer durable and non-durable goods have been down and out for 2021 and 2023 as well. If you see, broadly very muted growth, and even in 24, there was a pickup in the growth of the non-durables, but broadly it is not like on a broad-based way. As far as the services sector is concerned, services sector is the one that has been like going steady, progressing well as well. If you see the purchasing manager index, that has been month on month going, giving a head-on number of above 50, which basically indicates expansion. And if you look at the hardcore numbers in terms of the sectoral level as well, then whether it's the freight or cargo traffic, there also they had like ellipsed the pre-pandemic level, and passenger traffic, as explained earlier, that also has like ellipsed the pre-pandemic level. But there are like there is the railways passenger traffic, where there is a bit of a shortfall in terms of the pre-pandemic level. But the financial sector has been witnessing a very resilient and robust growth, as reflected by the non-food credit growth, which month on month has been showing double-digit growth, led by the services and the personal loans. But industrial credit growth has been like very muted. That is a bit of a concern. Moving on to the inflation side, inflation, as we know, that it had spiked to above 7% in July 2023, and that moderated somewhat in August, which was as per our expectations as well. But the good thing in these numbers, the latest numbers, is that the core part of it, which is like excluding food, energy prices as well, and that, if you see, that has like gone down below 5%, or around 5% level in August 2023, which is I think at the 23-month low, which is a good thing, that there is a gradual impact of the monetary policy by the RBI that is getting reflected. And wholesale inflation also has been like in overall in deflationary phase, but that is expected to change from September as crude oil prices jump have been hovering around 80 to $95 a barrel in September. Overall, we see that the inflation is expected to moderate to below 6% in the third quarter, and around 5% level in the fourth quarter, which is broadly in line with what the RBI has also projected. But the overall financial conditions are expected to remain quite tight, as the overall yield rate is which has been broadly hovered around 7.2%. So that has been there. And if you look at the overall liquidity level as well as percentage of the NDTL, that has been also low. And in fact, in August, it was at a 51-month low. So that was largely due to the implementation of RBI's incremental cash reserve ratio policy, where so that was also reflected in the low liquidity level. And if you see that overall credit growth, as I explained earlier, and the deposit growth is also expected to pick up, and the overall financial conditions are also expected to remain tight. And so far as the gradual impact of the there's a gradual impact of the overall monetary policy of the has been in a tightening phase since May 2022. And the reason why we say it's gradual, if you see that the repo rates, though they have increased by 250 basis points, but that has witnessed some bit of reflection, all of reflection in the deposit rates. But the fresh rupee loans that are they still have a scope of going up. So there is a bit of elevated levels of cost of capital that we expect, even if the repo rates are at a status quo level by the RBI. So overall, if you look at the overall macroeconomic outlook for FY24, we think that as per our projections for FY24, we think that the GDP growth would be going up from our earlier forecast of 5.9% to 6.2% in FY24, largely due to the fact that the overall government capex has been there has been a front loading of that, and it has been sustained throughout. And if you look at the overall investment demand as well, we think that it is at the cusp of beginning of a capex cycle. And but if you look at the overall retail and the wholesale inflation, we think that the wholesale inflation would be averaging at about 1%, and retail inflation would be about 5.5%. So it will definitely, there's a big moderation there. But and overall, if I say that current account deficit is also expected to be around 1.3% of GDP in FY24, and that is broadly due to the fact that overall your commodity prices, which have been on a moderation level as a year as a whole, that will definitely help us, the overall current account deficit being better than the previous year of FY23. Now, if one just zooms out and looks on a long-term basis, then though one thing is there, that definitely the recovery is good in terms of how it has panned out. 6% growth is good if one looks all over the world's biggest economies. But we have to also remember that recovering the lost pandemic output is going to be a long haul. The reason being that if you look at the green line, that basically shows us the pre-pandemic GDP trend, and the blue line indicates the projected GDP trend post pandemic. So that is still in FY24 is about 9.4% lower the trend. And in order to go above the trend or the GDP level, the annual GDP growth has to be around 7.6% till about FY35 on a sustained basis. And so clearly there is a long way to go for the overall Indian economy's economic recovery as well. So yeah, I will stop there. Back to you, sir.
Thank you, Paras, to sticking to 20-minute timeline. Thanks, that saves us time for discussion. So, ladies and gentlemen, we have Mr. Indranil Sen Gupta, who is the external panelist, and Mr. Sen Gupta is head of research at CLSA. He had a stint at RBI as staff economist, and after that he has spent 18 years in Indian markets, and he has been ranked as a economist by the institutional investors and asset survey over the years. He is also a member of government's working group on wholesale price index revision. And as all of us know, the CPI, WPI basket and their base year are changed after a gap of, generally it is a gap of 10 odd years, but this time because of pandemic, things are delayed. And Mr. Sen Gupta holds a master degree in economics from New Delhi's Jawaharlal Nehru University. So, Mr. Sen Gupta, welcome and thanks for being a panelist. Floor is yours. I would request if you could take 5 odd minutes to your initial remark about how the economy, how do you see the economy is shaping up, and what are the pressure points? Paras has pointed out some. If you hold a different opinion, please feel free to say so. Over to you, sir.
Thank you, Dr. Pant. Good afternoon, friends. So we are looking at a shallow recovery at CLSA, 6% growth this year, which is, I guess, below consensus. Essentially, we are looking at three pressure points. The first, of course, is that real lending rates have climbed 1,200 basis points. The second is that obviously, globally the economies are slowing, and that is hurting our exports. We think that a slowdown in the US will impact us by about 100 basis points. So in a way, you could argue that the very Fed tightening, which is forcing the RBI to raise rates, is also slowing the global economy, and therefore we are having to raise rates in India as well as feeling the brunt of slowing export demand. Finally, we had uneven rains, which is pushing back rural recovery. If you look at the GDP numbers, excluding the June quarters of 2023 and 2022, then the economy is growing somewhere around 5.5%. I mean, because these two quarters are essentially base effect driven. So that's our overall read on the economy. Turning to inflation, we were of the view that El Nino will push up India's inflation by 200 basis points. In the event it has, inflation did jump about 260 basis points. But my view always has been that, the impact of uneven rains don't last very long. And sure enough, inflation is coming down. And we think that, it will be back to around 5% by March, well within the RBI's 2 to 6% target or mandate. If you look at core inflation, that's already down to about 5%. So we are already at a real rate, I would say, of 1.5%. At a time when growth is relatively weak. Now, we do think that the RBI has been driven more by what the Fed does rather than domestic inflation. I don't think 5% core inflation warrants 6.5% repo rate. We think that if the Fed is done at 5.5%, which in fact is the CLSA view, the RBI should be in a position to cut by December. So we are looking at about 100 basis point cut by December. If, on the other hand, the Fed were to rise to 5.75, then maybe the RBI will have to hike once, but then again start cutting from February. So the point I'm making is that once there is clarity that the Fed is done, I think the dollar will price that in, the swap rates will price that in, and that will provide RBI the headroom to respond to the growth and inflation dynamics rather than the currency dynamics. So on the GSEC side, we are looking at a yield of 7% this year and 6.5% next year. We did expect some kind of a sell-off because clearly the US bond market was not pricing in, the Fed. There was a massive mispricing, which is now getting corrected. But then again, like I said, that, come December, come February, somewhere down the line, the RBI is going to look done, the Fed is going to look done. And therefore, we think that yields will come off. The other point I will make here is that as liquidity tightens, the RBI may have to do open market operations. and that also will support the Fed. I'm sorry, lower bond yields. In fact, the liquidity picture is a bit clouded. There are multiple factors at play. How much of the rupees 2000 notes are withdrawn? Then, the Russian oil exporters, how much GSECs are they holding? Till when? Where does do oil prices go? But then once you factor all this in various permutations and combinations, and look at the RBI's need to print, maybe around $50-60 billion of liquidity, the GSEC market is very, very likely to see excess demand after many years. So therefore, we think that bond yields can come down. On the currency, we are looking at the rupee appreciating to 80 by March, and this is largely on the back of a weakening dollar as the Fed begins to peak off. So we are looking at the dollar going to 1.18 a euro. It's obviously at 1.05, I think, right now. Now, of course, the rupee is at 83, and one question is that how can it go to 80? So we see three trends reversing. The first is that seasonality, which is against the rupee, will start to reverse in the second half of the year. As you know, during April to September, which is summer and rains, production is weaker, exports are weaker, so the rupee is weak. After that, the production picks up, exports pick up, and the rupee actually strengthens in the March quarter. The second is that when we look at external debt repayments, there is a $5 billion repayment in November, and I think about $4 billion in January. But after that, the pressures will come down, helping the rupee. And finally, like I said earlier, the dollar should weaken from here on once the Fed is done, and that should lead to some appreciation in the rupee. So net, we are looking at 6.6% growth. Basically, essentially a shallow recovery. We think the RBI can cut rates from December if the Fed signals a pause. And we think that the rupee will appreciate to about 80 by March. So let's stop here.
Thanks, Indranil, for a precise to the point view on the Indian economy. So I will start with Sunil and just take up from what Indranil has just said. So what is our house view on how the monetary policy conduct in the rest of the FY24 will take place, and when we can see the first rate cut according to Indranil, December, and if Fed hikes, then maybe shift to February 2024. And he is expecting somewhere around, if I heard it correctly, the 100 basis point kind of repo rate cut. Sunil, what do you expect on the monetary policy front?
Look, so far as RBI's monetary policy stance is concerned, broadly we see it to continue during the rest of the fiscal year. And with respect to the policy rate, we still believe that, if one tries to read most of RBI's narrative, then it appears that RBI is still not very comfortable with the current rate of inflation, which is 6.8%. And say, even if it comes down to close to about 5% by the end of the current fiscal, the current narrative of RBI appears to suggest that this will still not be enough for RBI to really have a relook at the policy rate. I mean, they would like the trajectory of inflation to fall further and come close to 4%. In my view, even though Fed stops the further rate increase, I think the domestic compulsion, which has mostly surprised the RBI on the upside, not so much on the downside, will make RBI, continue to look at the overall situation more cautiously than really believing that probably now that the core inflation is close to 5% and soon probably it will drop below 5%. So not only that the monetary policy is doing its bit, but gradually it will push the inflation close to the target level. So that doesn't seem to be the scenario, at least over the next maybe 6 to 9 months. And that's why, our view is that policy cut is unlikely in the current fiscal. Yes, if things turn out to be as RBI is expecting, that the inflation would drop to close to 5%, and the trajectory or their projection turns out to be that in the next couple of quarters it will be much closer to 4%, then certainly the repo rate cut may start the next fiscal.
Or is it so when we are talking about next fiscal, the first policy in the new fiscal will be in the April, which will be just a month before the general election, just assuming, like, I'm going more by when the election took place last year. So in that situation, do you believe that RBI will go for a rate cut in April or wait for the budget announcement by the new government? Because that will take it, then it will be not before the August policy.
Look, election certainly plays a role so far as decision making is concerned. But as I said, much would depend upon what kind of an inflation number finally we will arrive at towards the end of the fiscal. And we have already seen that government does not want that inflation or the current level of inflation should actually cloud some of the achievements which it wants to take it to the people. And that's why we have seen the LPG cylinder price cut and ban on the onion exports and so on and so forth. So all of these factors are clearly hinted at that while RBI is doing its job, government would also like to do its contribution in terms of not only anchoring the retail inflation, but retail inflationary expectation. While you may be right that there will be a pressure on the RBI to look at the inflation trajectory and see if they can do a cut in the April month. But, my sense is that much would be data dependent. So let's wait for the data.
So you mean to say, like, the monetary policy will wait for the direction from the fiscal policy before it takes a viewpoint? No, that's a fair call.
Yeah, because I don't think that much would come out of the budget presentation, simply because it will largely be a vote on account rather than a full-fledged budget. So
no, I'm saying July we will have the full-fledged budget. That's why I say if it is not, then it will wait till the August. Okay.
Absolutely.
Yeah. So that brings me to the most crucial question, which I think all economists in direct country, everybody is thinking on or trying to find out an answer. Indranil, I'll come to you first. The consumption. We have seen, like, whether you say haves and have-nots, or the upper income bracket, or the middle income trap, or the lower income bracket, kind of wage wage differential. So when do you see, either in your opinion or in your analysis, when can we see a sustained real consumption growth of say around 7.5% quarter after quarter? Because that is what will push the GDP growth, and that will also be a leading indicator for investment to revival. So if you can either consumption and when do you see after that investment revival? Indranil, you are on mute. Indranil, you have to
Yeah.
unmute
Yeah.
yourself.
Yeah. My apologies.
Okay.
So, I
No.
will break the consumption part into two. One is that rural, and the second is urban. So I think rural recovery cannot happen before the middle of next year. We had a bad crop. As it is, rural was hurting. If you look at real rural wages, they have been flat since 2017. If you look at the cereal price inflation, rice and wheat, that has gone into double digits, and that's about 19% of the rural household consumption expenditure. There is also some degree of distress because of which you have NREGA numbers rising from 2017 levels. The good news is that while this crop is impacted, there is sufficient water in the north because of heavy rains, and that should make for a good Rabi wheat crop. So the south is impacted, the east, but the west and the north are have sufficient water. So we think that next year there should be rural recovery. So that's point one. Turning to urban consumption, I think that this again becomes a function of the real lending rates, which have risen by almost 1,200 basis points since August, when you deflate by WPI. So these lending rates have to come down. Some of it will, there is a base effect in WPI itself, but then beyond that, the RBI has to bring down interest rates. Because what has happened is that you have linked the lending rates to the weaker sections of society to the repo rate, because you wanted to bring lending rates down for housing, for retail, for small and micro industries. Now, you had to raise the repo rate to support the rupee, and unlike before, the problems of the compulsions of the FX market are now getting passed on to the credit market. So ironically, if you look at the interest rate increases for mortgage, for priority sector and so on, that is higher than the MCLR. If you look at priority sector mortgage loans, they are hardly growing. Overall, mortgage loans are growing, but not priority sector mortgage loans. So, if effectively speaking, this cuts both ways. One is that obviously, consumption loans have become costlier. The other is that as SMEs get hit, a large chunk of urban population that depends for employment, especially in tier 2, tier 3 cities, on SMEs also can to face job uncertainty. So I think that these two factors have to reverse. One is, of course, essentially an act of nature, and looks like next year there will be a good crop because there's sufficient water. But the other will have to wait for lower rates and greater job certainty for people to buy. Right now, what is happening is that not only is consumption weak, but basically there's a premiumization going on, that the better off are doing better, and therefore more expensive cars and so on are selling far better than baseline cars, two-wheelers, and etc. So, so that also, emanates from the same set of factors that I spoke of.
Any view on when the private capex you believe will start
So-
because as of now it's the government, and with the fiscal constraint, high debt, high deficit, there's a limit to which the government can continue to spend.
So, we've been talking of 2-3 years from now, since for the last 10 years now, about private capex. I think one good part is that, even though the economy has largely been operating below potential, in certain industries, we are hitting capacity like steel and so on. So there's some amount of capex beginning. But otherwise, yeah, I mean, the economy has to stabilize, and maybe that takes another couple of years at least. So I would think that the global cycle may start to turn around in the next 2 years, and then alongside India will turn around, because even if you see the US, if the Fed were to stay at 5.5%, which it professes it will, and inflation is around 3%, 2% real rate is extremely high for the US. If you chart, you find that every time the real Fed rate has gone to 2%, the US has faced recession. Right. So therefore, I think that maybe there's a slowdown in the offing next year if all these forecasts hold. But then after that, we will see a turnaround in the cycle, and then in capex pick up. But I do think that right now, that is some way off.
So it's mainly like if we how the external demand revives and how the internal, so put it, I have the external and internal demand, and that will start using some of the idle capacities, and then it will start, the private capex will start. And in today's scenario, it's very difficult to put a timeline, like whether we'll see one quarter down the line or 2 quarter down the line. The only good thing is your corporate balance sheets are much better. The banks, I think maybe 2 decades back or one and a half decade back were in this situation. So as and when it will take the investment demand starts picking up, both banks as well as corporates are in a position to fund it. Sunil, coming to you, see, you have pointed out the external demand, inflation. How big you see the inflation as it is? Though what you have said and what general opinion is inflation by end of the year will come down to somewhere around 5%, and then going back to 4% only in FY25. I still remember one of the post monetary policy interaction with this researcher or with the journalist. The RBI was of the opinion, and they clearly said we are not approaching 4% anytime in FY24, and our aim is to bring it down to around 5% by end of FY24, and then going to the to 4% post that. So any though in today's time when everything is so global, and any hint or any timeline you have, like you can tell us when it will reach 5%, and post that, do we see it going to the 4%? More importantly, the remaining around 4%. You have to unmute, Sunil.
Yeah, we are in an uncertain world. These days, projecting a scenario even 6 months or 9 months down the line has become difficult. Because the way the inflation behaved in the last 2 months was never anticipated. On the contrary, the expectation was that the inflation trajectory will move downwards in the second quarter and third quarter, and probably by fourth quarter, RBI will get to the 4% retail inflation. But that has not been the case. And even going forward, even though at the current juncture, the way things are shaping up, we are expecting the retail inflation to come down to 5%. And thereafter, of course, if in a ceteris paribus condition, we would expect that probably it will come more closer to the RBI's target level of 4% in fiscal year 25. But of course, all of that will depend on number of factors. First, of course, will be how the monsoon pans out the next fiscal, and also what happens to the global commodity prices, which is a major input for the Indian economy. And my sense is that the international commodity prices probably would remain soft. Simply because the going is not good so far as Chinese economy is concerned, and much of the movement in the global commodity prices we have seen due to what happens to the China. So if that remains somewhat down and out, so global commodity prices may remain soft. And if we combine it with a normal monsoon, which can have again impact on the overall food inflation. So food and oil are the two key drivers of the inflation in the Indian context. And if both of them turn out to be as per our expectation, then certainly, I mean, as I said earlier, the repo rate may come down in fiscal year 25, and also we may come closer to the 4% target level of retail inflation. But the fact remains that inflation has been in the past, and even going forward will be one of the major risks, because inflation not only seeps into economy from the consumption side only, it impacts through the investment side as well. So if the cost of capital goes up, it hits a lot of people who undertake consumption through the leverage route, and similarly for the corporates who probably are looking at the current juncture, the revival of a private corporate investment cycle. They may also be a little wary. But let me also say that finally the rate of interest is not the driver of private capex. The driver of private capex obviously is firstly the consumption, and how the consumption demand translates into capacity utilization, and subsequently to the investment demand. So that's the route. So monitoring the inflation and inflationary expectation will remain the most crucial component of determining the growth trajectory of the Indian economy.
Thanks, Sunil. Thanks. There are too many questions in my mind, but in the interest of time, I'll request participants to start raising their hand. I'll go back to Indranil if he has a different view on what Sunil has just said, or if you want to add on, then we will open to the participants for their questions.
No, we can start with the participants.
Okay, right. Thank you. So participants, either you can type on chat or raise your hand. Amaya will unmute the lines and you can ask your question. Amaya, are you getting any questions on chat or Q&A? At least I can't see it.
Not as of now.
Okay. So no question from any participant, then I'll continue. I have a couple of more questions, and so that we'll wait for a minute or so. So in the meanwhile, if we anybody raise question, if we could continue, we have another 6-7 odd minutes from the webinar, and having you, let's utilize that time. Oh, as I said, there's a question which popped up. This is from Naveen Sorot. I don't know whether I pronounce name correctly or not. If I incorrectly pronounce, sorry for that. Indranil, any view on premiumization that we are seeing in consumer durable and auto?
So I think there are two things here. One is that premiumization is obviously a long-term thing. Like, as India grows wealthier, people are moving to more premium products. So the other thing is that things are also becoming more affordable. So one example I keep giving is that the price of an entry-level car, which was like about 14 times, I think, of India's per capita income in 2000, is today hardly 2.5 times, and maybe become like 1x, in the next 10 years. So that's the long-term story. What is probably happening right now, and this is something we have done surveys and found, is that essentially you are seeing income inequality rise post-COVID shock. Post the COVID shock, and this becomes very evident, in our surveys, both in urban and in rural areas, and therefore you are in a situation where there is, more expensive brands and so on are selling more than less expensive brands. So there's a long-term element and a short-term element. The short-term element hopefully will reverse, but the long-term trend is obviously that you will demand more and more premium products.
Okay, thanks. Indranil, the second question is, I'm taking it as they are appearing on screen. Paras or Sunil, you could answer that because this is from India Ratings FY24 growth forecast. Estimated service segment growth for FY24 is 7.7%. What is the biggest drag among services?
Paras, you want to take this one?
Yeah. So we see that broadly the trade sector, the hotels segment, that will be a bigger driver for the services in FY24. But the drag or in the real sense, I don't think so. But the lower growth would be broadly in the financial services of the real estate sector, where we see that it would be broadly coming at about 6% in FY24. But that's also good in terms of overall trend if you look at the all across the other supply side drivers. But the key driver would be the trade and hotels and transportation segment.
Thank you. Anybody, whether Indranil or Sunil, can take third question. I don't think anybody has done that. We need a trade economist for that. Any comment on impact of India-UK trade agreement with respect to specific industries?
No, we don't have.
Yeah. So Bipul, sorry, now I don't think that neither CLSA nor India Rating has done any specific studies on that, like industries which will be impacted. But yes, the rule of thumb says wherever any country will have advantage over the other, India having advantage over the UK, or UK is having over India, that will they will be the gainer. Next question from Rushabh Shah is for you. Indranil, USD and are going to 80 as per your outlook. What are your expectation on forex reserve at that time? Also currency effect on exports and imports.
So we are looking at FX reserves around 650 billion. Right now, I think they're around 620 billion. The accretion to FX reserves is coming less from RBI buying in our forecasts than from the income on FX reserves, because as you know, the RBI has currently about $500 billion plus FX reserves, and even if you impute 4% return, then you are getting $20 billion. The second is that if we see the dollar going to 118 a euro, then we also get a fair bit on the revaluation side. So, this is much more on the revaluation as well as the income on foreign assets that is driving our forecast. We have we have nil FX intervention really in our model, which also we have not taken in, whatever is pending to Russian exporters. So I think that if you put that in, maybe, the RBI should be buying $30 billion, and it's bought about 20 billion. So that remains a joker in the pack.
Okay, thank you. The next question again from Vipul Ghosh. India-US interest rate differential is reduced. What would be the impact on capital flows?
So I think that there are, the impact on capital flows depends on whether you are at extremes or you are in the middle in a normal situation. So, for example, I think we were arguing continuously for higher RBI rates because it was profitable to sit in the dollar. Because if you look at the swap rate itself has been coming down now because the dollar expectations are changing. So when you are in an extreme situation where the Fed is raising the rates the way they are now, or when they were raising in 2006, the RBI and all emerging markets have to raise rates or face capital outflows. And indeed, you will see that debt FPIs have pulled out almost everything, in this whole episode of post-COVID. In a normal circumstance, paradoxically, higher rates actually drive away capital flows and lower rates attract capital flows. The reason is that in India, you have FPI equity investment at about 650 billion today, and FPI debt investment at barely, I think, 30-40 billion, 30, close to 40, I think, billion dollars. Now, therefore, the equity logic in India dominates the debt logic to a large extent. So typically, what happens is that if the RBI were to raise rates like it did in 2013, the equity market says that, look, growth is going to suffer, and they leave, right? And if you think about it, in July when the RBI raised rates, the rupee was at 59, and then it went to 67. Right. And what happens is that if you are a debt market investor, you see equity markets leaving, rupee depreciating, so you also leave. So this is something that I think Governor Subbarao once called the Indian exceptionalism. And this has been a consistent view, I think, I have had for many, many years. The other is that when you talk to debt investors, this whole parity thing is about the incremental rupee people will put in. But you think about it this way, that you put in $100 in an economy, and that central bank raised rates and you lost money. Is your investment committee going to allow you to put in another rupee, another dollar, or say that now you cut your losses? So in a more normal situation in India, I think this is fairly unique to India, from what I can see even amongst emerging markets, that higher rates lead to lower capital flows and vice versa.
Thanks. Since the time is over, I will just answer the one last question, like any change in government in case BJP fails to win. Just look at 1991 till now. Unlikely that you will see a major decision taken by the previous government was reversed by the new government. So to say, the dream budget for the equity market was presented at a time when we have whether you say the Khichdi Sarkar or a coalition of 15 or 13 parties, just priorities changes. So it is not that 91 reforms, any major things was altered by other governments. Yeah, you can say like private disinvestment, whether it is a privatization with giving the management control to the private sector, or just selling some residual stake. But last couple of years, we have seen the disinvestment receipts are not what they were assumed in the budget. So with this, I'll hand it over back to Ameya. And personally, thanks to Indranil and all the participants to join it. Ameya, over to you.
Thank you, sir. Thank you. Participant, I would request I'm launching a poll. Just spare you a couple of seconds to answer the poll. It will be help us to get best possible webinars to you as per your feedback. And meanwhile, I would like to thank Mr. Indranil sir and other participants, Dr. Sinard, Paras, and Dr. Pant for this interesting, insightful session. And also thanking obviously of our attendees to attend our webinar. Thank you so much.
Thanks, Indranil. Thanks, everyone. Thank you. Thank you.
Thank you.
Thank you.
Thank you. Yeah, Indranil, you can log off. Yeah. अमेया, ये क्वेश्चंस तुम्हारे पास हैं?
हाँ सर, ये क्वेश्चंस आ जाएंगे मेरे पास.
हाँ, क्वेश्चंस ठीक है. Okay. Thank you.
Thank you, sir. Thank you so much.
Thank you.
Bye.
Thank you. Thank you. Yeah.